Hi, this is Patrick Adams, and we're going to talk about something critically important for you to know this week is what is a market cycle? You have to know where you are in a market cycle to know where you're going, right? I love this chart. This chart says it all. A market cycle is the bull, followed by the flattening period, the topping, followed by the bear, and then it starts over again. So I want to give you an example. This is March of 2009. The Federal Reserve had cut rates down to zero, kept them there for 13 years. This is stage two. This is where we want to invest. This is where we want to be long as much as we can and ride that bull. Stage three is when the Federal Reserve starts to raise rates. This is March of 2022. And they may raise rates for a period of time, like they did or are, and then ultimately have to cut rates, and which puts us into a economic downturn because they're reacting to what's happening in the economy. The economy falls for a period of time, as well as the stock market, and generally these are 30 to 50% type of declines. So full market cycle, we are in stage three. That's so important to know where we are, to know where we're going. We want to come back to stage one to be fully invested, to take advantage of stage two. We're not close to that. We think we can make some money here in stage three. When the Federal Reserve stops raising interest rates, we're going to get a continuation of this rally. And then ultimately, roughly probably 6 to 12 months from now, they're going to be forced to have to cut rates. So that probably puts us into the end of this year, into maybe the second quarter 2024, where we could be in a nasty bear market. So let's examine what happened in the last cycle. The last cycle looks a lot like this cycle, actually. So the last cycle, the Federal Reserve began raising rates in July of 2004 and raised rates for 2 years. Not 1 year like they did this time, but 2 years, and finally got the federal funds rate to 5.25. So they raised rates by 4.25%. Then they had to cut rates. Of course, they kept rates flat for an extended period of time. Then they had to cut it, and they cut it all the way down to zero by March of 2009. So this cycle, the current cycle that we're in, they started raising rates when rates were roughly zero. Rates are now 4.75% in the Fed funds to 5%. There could be one more rate increase or not, but we're already up 4.75% over a 1 year period. So this time rates have gone up faster and more, and they're talking again about an extended period of time. I view an extended period of time as at least 12 months. So what happens? So looking back at the prior cycle, this is where the Fed stopped raising rates. This is July of 2006. The market actually went up 18.5% through that period after the Federal Reserve stopped raising rates. So there is a knee-jerk reaction to the Fed pausing. So we think we're in that period of time now. The differences are between now and then. Now the valuations of the market of the S&P 500 is roughly 18.5 times. Then it was 15.5 times. You also had a little bit of the kid who cried wolf, the boy who cried wolf. So he's cried wolf so many times at this point that the Fed's going to stop and they're going to pivot. Well, they haven't. The Fed's continued on. The market's kind of hung in there, and now is anticipating that I think we're done. If maybe we have one more federal funds rate increase, maybe not. But then you have that extended period of time where the market can rise through here, and we're not going to see an 18.5% rise, but we're going to see probably a continuation of what we're currently seeing, maybe up 5% from the current levels. And then the Federal Reserve obviously is going to have to cut rates because the economy won't be able to handle it, and we're looking at a pretty severe decline in front of us. maybe not as bad, maybe not a 50% decline like we saw in 2007 to early 2009, but a very significant decline. So again, what happens when the Fed stops raising rates? You get a pop in the market. We're not going to see the same sort of pop. Now, I like this chart. We showed this chart last week. This is what happens when the Federal Reserve pivots. So you go back and you look at when it pivoted. They did their pivot in 2007. That was the high of the market. They had to cut rates. We kind of went through this. The market fell over 50%. Again, the same sort of scenario that occurred in 2000. Fed started cutting rates, the market fell over 50%. When the Fed cuts rates, it's really negative. The market goes down because they're cutting rates for a reason. So that's entering a bear market. That's when the cycle turns over. We are in stage 3, and we're going to go into stage 4. Our guess is 6 to 12 months from now, we'll be moving into stage 4. What we want to do is invest in this stage 1 period here and get the benefits of stage 2. We can make money in stage 3, but we have to be tactical, right? We have to pick our spots. And then stage 4, we have to be ultra defensive. Again, you have to be tactical. So we want to get back to stage 1 without having experienced much of this stage 4 decline, and where we can make a lot of money. Okay, so looking at what's coming up in front of us, we have CPI on Wednesday, PPI on Thursday. I'm not concerned about CPI and PPI anymore. I think we're going to see a continuation of the decline in the trend of inflation, and the key component is oil prices. Oil prices need to stay at a reasonable level. If they don't, then inflation is going to rekindle, or it may push us into a recession this time. So we do have a recession in front of us. It's happened repeatedly as the yield curve has inverted. It always happens. That's in front of us. But don't be concerned about CPI and PPI, in my opinion. We'll see those on Wednesday and Thursday. The key thing to watch is oil prices. Friday, this could be the catalyst. We get bank earnings on Friday. We got JP Morgan. The consensus is up 27% in earnings. That happens, the market's going to like it. Also get Wells Fargo on Friday. Up 32% in earnings is what the market's looking for. Again, if that happens, the market's going to like it. Citigroup doesn't matter. They have a different way of funding their deposits. It's not important. It's you can see what the issues in the banking system are on Citi's earnings. PNC, regional bank, they're going to be a little bit impacted by what's happening in the banking sector, but not a great deal. Should be up 12%. What the market's going to listen for is the commercial real estate loans, how they're performing. Thank you very much. Hope you appreciate this video. Again, extremely important to know where you are in the market cycle. We're in phase 3. Again, on May 3rd, when the Federal Reserve doesn't pivot, but they either raise rates one more time or they don't, the markets will probably rally on that some more. But then we're going to enter a bear market roughly 6 to 12 months from now. I know these things. I've been doing this for 37 years. I'm an expert. I ran large pools of money. I've seen this occur over and over again. You need to know this. Avoid that stage 4 and get set up for stage 2. Thank you very much. If you like the video, hit like, hit subscribe. And if you want to receive our Market in a Minute update every week, go to my website, Patrick Adams CFA, and subscribe to Market in a Minute. We'll send it to you via email. Take care.